So our banks, and by extension us, are at the mercy of the international money markets. The effects of the global financial crisis, which began 3 years ago this week, are clearly still with us. For the big picture on where we are right now, I spoke to Robert Mead, Head of Australian Portfolio Management at Pimco, the world's biggest bond house. Robert Mead, welcome to Lateline Business.
Thanks very much. It's great to be here.
Now, Pimco talks about the new normal that we have in the world today. What do you mean by that?
Well, the new normal is really just an adjustment of sort of the financial and economic sectors, whereby the delevering that was, the levering up that we saw leading up to 2007 is sort of now into the delevering phase. So a lot more deleverage, a lot more re-regulation, and even some deglobalisation sort of being the major forces of economies and markets over the next sort of 5 to 10 years.
Where does that leave opportunities in the Australian market?
Well, for Australia, I think we're in some ways a sweet spot, having some emerging market characteristics to our economy through the resource base that we have, and also having sort of developed market perspectives through consumer indebtedness, etc. So from a bond perspective, we're actually in a very favourable position to the extent we don't have much debt as a country. Our yields are still in the sort of 6% range, even higher if you include some credit spread into that mix. And you also have sort of inflation in the 3% range. So for an investor to be able to earn a real return of 3 or 4%, so every year your own purchasing power can go up by 3 or 4%. It's actually a very attractive market to invest in.
And yes, do you see as interest rates are rising that bond markets, returns from bonds will actually be able to keep up with equity markets, because we've got a pretty strong reporting season at the moment?
Well, I think so. And if you take that new normal backdrop, the deleveraging that we are expecting will impact returns on equity almost by default. So if companies and banks, etc., are forced to run higher levels of capital, lower levels of debt than they would have sort of in the old normal, then returns on some of those risky asset classes, we believe, will be permanently lower, making the sort of relative returns available within the bond market attractive on an absolute or a relative basis.
The ANZ today has said it won't be raising rates beyond the RBA for now. How long do you think Australian banks will be able to keep that up, given the need for all this refinancing in Europe, for example?
Well, I think it's one of those things where the RBA has been very clear in terms of their own statements in regard to they adjust their own policy rate to take into account the cost of borrowing at the sort of end borrower, consumer or business level. So the real pain can happen within the sort of in the gap where the banks have to pay more for their funding, but the level of rates to the end borrower may not change that much. So if you think about the last interest rate cycle with the RBA reaching 7.25, this cycle they've stopped at 4.5. We believe that the rate cycle probably peaks somewhere between 4.5 and 5, which leaves some more flexibility for the banks to sort of deal with their funding problem and be able to pay some higher rates in terms of getting that funding done.
In June, you backed strongly the government's $16 billion investment in residential mortgage-backed securities. I think you said they were as close to bulletproof AAA as you can find. Are they still as attractive as they were in June, or are spreads coming in now?
No, they're very much still as attractive. There's the statements I made in regard to bulletproof referred to sort of some of the very well structured older vintage mortgages. So some of the transactions that were done sort of through the 2004 to 2007 period. And we still firmly believe that that's an asset class that's very attractive to investors.
And for new issuers, like we spoke to Bendigo and Adelaide Bank yesterday, which are sort of in the middle of rolling out new issues, is that likely to be well received by the market?
I think so. It's, the AOFM is still sort of strongly supporting the non-major bank originators of mortgages to ensure that there is competition in the mortgage market, and the spreads to the investor continue to be attractive.
Tell me about Pimco's specific strategy when it comes to investing. You have a risk-controlled approach to bond markets, don't you?
Yeah, we look at risk across a whole range of different metrics. So not just to credit risk or not just interest rate risk, but also looking at things like currency and very importantly, more recently, also factoring in policy risk. We see policy risk as probably one of the key new risks that came out of the GFC. And when I say policy risk, it's looking at sort of non-market players, whether that be a regulator, central bank or a government, sort of getting directly involved in the marketplace. And AOFM is a classic example within the Australian context.
And finally, are we likely to see a lot more opportunities for you in terms of arbitrage opportunities, given the volatility of markets at the moment?
Well, yeah, it's definitely an opportunity-rich environment, Tiki, in terms of being an investor. It's very much a noisy marketplace where strategic investment across the market is still throwing up immense opportunity.
Robert Mead, thank you very much for talking to Lateline Business.
It's my pleasure. Thanks very much, Tiki.